Welcome to the U.S. Market Daily Summary for Tuesday, December 30th, 2025. As we approach the end of an eventful year, the market seems to be in a state of reflection. I'm David.
And I'm Sarah. David, today felt like a microcosm of the year's biggest tensions.
Yeah,
A real tug of war between growth and safety, and a market trying to decide what comes next.
that is the perfect way to frame it. Today's session saw equities finish mixed,
Right.
with some profit taking in the high-flying tech sector, while assets like precious metals found a really strong bid. The big themes are clear. You've got this narrow market leadership,
Okay.
conflicting sentiment signals, and some major moves in the bond and currency markets.
Let's look at the closing numbers. So the S&P 500 ended just shy of that 6,900 mark, down a fraction. The Nasdaq, which, has been the star performer all year, it finished flat,
Wow.
but is holding on to a remarkable 21% gain for 2025. It's a market pausing at a very high altitude.
But that high altitude is being held up by just a few climbers. When you look at market breadth, the number of stocks going up versus down, the picture is so much weaker. Only 42% of stocks advanced, while over 54% declined.
Wow.
That tells you the average stock had a rough day.
It's a classic negative divergence. The indices, they look stable,
Right.
but underneath, more stocks are losing ground than gaining it. This is not the foundation of a durable, broad-based rally.
Exactly. And this internal conflict is perfectly captured by the sentiment indicators. On one hand, you have the VIX, the fear gauge, at a very calm 13.6.
Okay.
The CNN Fear and Greed Index is right in the middle, neutral 49. So no panic here, right?
But look closer. The NAAIM index shows professional managers are nearly all in on stocks. We're talking 95% exposure.
Yeah.
Yet at the same time, the options market is just screaming extreme fear. To put it simply, the pros are fully invested, but they are paying up for downside protection. Emphatically, someone is going to be wrong.
Oh, absolutely. And you can see this flight to safety in the sector performance. The top performing sector this month wasn't technology.
Oh,
It was healthcare, up a stunning 9.29%. That's a purely defensive move. Investors are selling growth and buying stability.
and the options data confirms it. The put-to-call ratio on the S&P 500 is 1.15. In simple terms, that means for every 100 bullish bets,
Right.
there are 115 bearish bets or hedges. So despite that calm VIX, smart money is buying insurance.
Now, let's turn to the bond market because there's a seismic shift happening there. The 10-year Treasury yield is holding firm at 4.16%.
Okay.
But the real story is the shape of the yield curve. It is steepening,
Yeah.
with the 10-year yield now a healthy 0.68% higher than the 2-year.
And for much of the year, that relationship was inverted,
The classic recession signal, yeah.
which is a historical recession warning. So seeing the curve return to a more normal, upward slope is a powerful sign that the bond market is looking past recession fears and maybe toward a period of more stable growth.
Absolutely. And this has huge implications for the US dollar. The dollar index, the DXY, has taken a beating, falling to 98.14.
Wow.
It's on pace for its worst annual performance in years, down nearly 10% in 2025.
And a weaker dollar often acts as fuel for commodities, right? Gold is reclaiming its shine, rallying back towards $4,350 an ounce. But the real firework today was in silver, which staged a massive 7.7% rally. Meanwhile, WTI crude was the quiet one, holding steady at $58 a barrel.
Looking ahead, the entire market is waiting for 2 p.m. Eastern tomorrow. That's when the Fed releases the minutes from its last meeting.
Right.
And traders will be dissecting every single word for clues about the path of interest rates in 2026.
So, bringing it all together, the near-term outlook is, I guess you'd call it cautiously constructive. The market is walking a tightrope. That S&P 6,900 level is the key pivot to watch. A break below could signal a deeper pullback.
From a tactical standpoint, this This just isn't a market for aggressive bets. The advice is to be selective, focus on quality, and, consider keeping those hedges in place. So for the final trading day of 2025, we'll be watching three things. Can the US dollar find a floor? Can precious metals continue their rally? And most importantly, can the bulls defend S&P 6900 into the close?
A thrilling setup for the year's grand finale. Thanks for the insights, David.
Thank you, Sarah. Now, here's a question for our listeners to think about. With professional investors fully invested but hedging aggressively while the average stock is falling, who do you think is seeing the market more clearly right now? The indexes or the internals?